Hello everyone, welcome back to the Healthy Luxuries Channel. Today, we're embarking on an insightful journey into the world of trading. In the vast universe of financial markets, trading can sometimes feel like navigating through a labyrinth. But fear not, we're here to guide you, especially if you're just starting out on this exciting path. Now, when we talk about trading, one name often dominates the conversation: Warren Buffett, the Oracle of Omaha. Through his simple yet profound wisdom, he has carved a niche for himself in the world of investing. But what might surprise you is that his principles can also be applied to trading, and that's the crux of our discussion today. We're going to delve into the heart of Buffett's philosophy and distill key nuggets that can be tailored to the needs of beginner traders. Whether you're new to the stock market or looking to refine your strategy, these insights are designed to set you on the path to financial success. Buffett's philosophy revolves around long-term value investing. But what does this mean? In essence, value investing is about finding and buying stocks that are worth more than their current market price. These are often stocks of companies that have strong fundamentals, such as a solid management team, sustainable business models, and a history of profitability. Now you might be thinking, how do I find these undervalued stocks? Well, it's not as daunting as it may seem. Start by looking at the company's financial health. Are they making profits consistently? How about their debt levels? Companies with low debt are often more resilient in times of economic downturns. Next, consider the company's competitive position. Do they have a unique product or service that gives them an edge over their competitors? This could indicate a potential for sustainable growth, which is a key factor in long-term value investing. Another important aspect to look at is the company's price-to-earnings ratio, or PE ratio. This is a simple calculation that divides the company's current share price by its earnings per share. A lower PE ratio could suggest that the stock is undervalued, although this isn't always the case. And finally, consider the company's dividend history. Companies that regularly pay dividends are often more stable and profitable. Plus, these dividends can provide a steady income stream while you wait for the stock's price to appreciate. Now, it's important to remember that value investing is not about making quick profits. It's about finding companies that are likely to grow and become more valuable over the long term. This requires patience and a willingness to hold on to your investments even when the market is volatile. By focusing on the long term, you can set the stage for successful trades over time. Remember, as Warren Buffett himself once said, our favorite holding period is forever. So embrace the wisdom of one of the greatest investors of our time and embark on your journey towards long-term value investing. An economic moat is a competitive advantage that allows a company to outperform its peers. This concept, borrowed from medieval times where a moat protected a castle from invaders, applies to modern businesses as well. In the realm of investing, economic moats refer to the unique advantages a company possesses, allowing it to fend off competitors and maintain its market standing. There are several types of economic moats. A low-cost production advantage, for instance, allows a company to undercut competitors while still making a profit. Think of large retail companies that can buy in bulk and sell at lower prices, making it hard for smaller competitors to match their prices. Another type of moat is the network effect, where the value of a product or service increases as more people use it. Social media platforms are a great example of this. The more people that join a platform, the more valuable it becomes, creating a self-perpetuating cycle of growth. Brand identity can also create an economic moat. Some companies have such strong brand recognition that it's almost synonymous with the product they sell. This strong brand recognition can serve as a significant barrier to entry for potential competitors. Switching costs are another form of economic moat. If a company's product or service is so integral that it's expensive or inconvenient for customers to switch to a competitor, that company has a clear economic moat. Lastly, patents and licenses can provide an economic moat. These legal protections prevent competitors from copying a company's product or service, giving the company a monopoly in that specific area. Understanding these various types of economic moats can guide your stock selections for more strategic trading. Companies with strong economic moats are likely to sustain their competitive advantage, leading to long-term profitability. However, remember that an economic moat isn't a guarantee of success. Companies must continually innovate and adapt to maintain their moats, and even then, market dynamics can change. Recognizing a company's economic moat can be a powerful tool in your trading strategy. It's about finding businesses that can defend their castle, keep competitors at bay, and continue to grow profitably for the long term. In essence, a strong economic moat can be the bridge to your trading success. Buffett often emphasizes the importance of patience and discipline in investing. These two virtues, while seemingly simple, are pivotal to your success in the world of trading. They're the invisible forces that can make or break your trading journey. Now, let's talk about patience. Trading is not a get-rich-quick scheme. It's a marathon, not a sprint. It's about making calculated decisions and waiting for them to bear fruit. It's about weathering the storm when the market gets tough and holding on to your investments when others are panicking. As Buffett famously said, the stock market is a device for transferring money from the impatient to the patient. This is where discipline comes into play. Patience without discipline is like a ship without a rudder. It's discipline that keeps you on course, especially when the sea gets rough. It's discipline that stops you from making impulsive decisions based on market rumors or temporary downturns. It's discipline that prompts you to stick to your trading plan, even when your instincts might be screaming otherwise. It's worth noting that emotions are the arch nemesis of discipline. Fear and greed can cloud your judgment, leading you to stray from your plan. But discipline helps you to resist these emotional pitfalls. It teaches you to trust in your strategy and not be swayed by the turbulence of the market. But how can you cultivate patience and discipline? Start by setting clear, realistic goals for your trading journey. Stick to your plan and resist the temptation to make hasty decisions. Practice emotional detachment from your investments. Remember, you're investing in businesses, not just buying pieces of paper. Lastly, always keep learning. The more knowledge you have, the better equipped you'll be to make informed decisions, which in turn fosters patience and discipline. In conclusion, patience and discipline are not just virtues, they're necessities in the world of trading. They're the compass that guides you through the market's unpredictable seas, helping you reach your destination of financial success. Managing risk is a cornerstone of successful trading. It's not about avoiding loss entirely, but about understanding the potential for loss and taking measured steps to mitigate it. The legendary Warren Buffett has always been a staunch advocate of this principle. So how can we apply his wisdom to our own trading journey? Firstly, we need to understand the concept of margin of safety. This is a principle Buffett borrowed from his mentor, Benjamin Graham. It is the difference between the intrinsic value of a stock and its market price. Buffett suggests buying stocks when their market price is significantly lower than their intrinsic value. This provides a cushion or margin of safety against potential losses. Secondly, Buffett is a firm believer in diversification. While he advocates for investing in what you know, he also stresses the importance of not putting all your eggs in one basket. A diversified portfolio can help spread the risk and potentially smooth out the bumps in your trading journey. Thirdly, Buffett advises against using leverage or borrowed money to trade. While leverage can amplify your profits, it can also magnify your losses. In Buffett's view, the potential for higher returns is not worth the risk of devastating losses. Lastly, Buffett emphasizes the importance of having a clear and well-thought-out trading plan. This includes setting your trading objectives, deciding how much capital you're willing to risk, and establishing your exit strategy. With a solid plan in place, you're less likely to make impulsive decisions that could jeopardize your trading capital. Remember, trading is not about making quick bucks. It's about making informed decisions, managing your risks, and patiently waiting for your investments to bear fruit. As Buffett himself once said, the stock market is a device for transferring money from the impatient to the patient. Risk management isn't about avoiding risk, it's about understanding and managing it. So equip yourself with the right knowledge, stay disciplined, and navigate your trading journey with confidence. Until next time, happy trading. Buffett is known for his voracious appetite for learning. A key part of his success is an unquenchable thirst for knowledge, a trait that is not only admirable but crucial in the rapidly changing world of trading. One might say that the financial market is a vast ocean, ever dynamic with currents that change direction at a moment's notice. As beginners, it's easy to feel overwhelmed by this constant flux. But here's where continuous learning comes into play. By constantly seeking knowledge, you can stay abreast of market trends, understand new financial instruments, and adapt your trading strategies accordingly. Whether it's reading financial news, analyzing market reports, or even listening to podcasts about trading, every bit of learning counts. Remember, each nugget of knowledge gained is a step towards becoming a more informed and effective trader. Never stop learning, because the market never stops teaching. In conclusion, trading for beginners doesn't have to be daunting. We've charted a course through the vast ocean of trading, guided by the wisdom of legendary investor Warren Buffett. We've discovered the power of long-term value investing, understanding the importance of identifying companies with strong fundamentals and potential for sustainable growth. We've delved into the concept of economic moats, a competitive advantage that can set a company and your trades apart. We've recognized the importance of patience and discipline, virtues that help us resist impulsive decisions. We've talked about risk management, a cornerstone of successful trading, and how it can protect your capital while seeking profitable opportunities. Finally, we've understood that continuous learning is essential in the ever-evolving world of trading, echoing Buffett's own voracious appetite for knowledge. Armed with these key insights, you can navigate the markets with confidence and increase your chances of success. Thank you for joining us on this enlightening journey. If you found value in this video, don't forget to like, share, and subscribe for more.
I just read and read and read. I probably read 5 to 6 hours a day. I don't read as fast now as when I was younger, but I read 5 daily newspapers. I read a fair number of magazines. I read 10Ks. I read annual reports, and I read a lot of other things too. So I've always enjoyed reading. I love reading biographies.
How can other people tap dance to work? What's the secret of that?
You find your passion. You find your passion. I was very, very lucky to find it, when I was 7 or 8 years old, and fortunately, my children have found their passion. One son loves farming like nothing else. One son loves music like everything else, and all 3 of them love philanthropy and what they get to do. You're lucky in life when you find it, and you can't guarantee you're going to find it in your first job out. But I always tell college students that come out, I say, take the job that you would take if you were independently wealthy. You're going to do well at it. The most important thing is to be able to define which ones you can come to an intelligent decision on and which ones are beyond your capacity to evaluate. You don't have to be right about thousands and thousands and thousands of companies. You only have to be right about a couple. I don't have to understand all kinds of business. There's all kinds of business I don't understand, but there's thousands of opportunities there. I did understand the Bank of America, and I'm able to do that. If you think you're going to be a lot happier if you've got 2X instead of X, you're probably making a mistake. I mean, you ought to find something you like that works with that, and you'll get in trouble if you think that making 10X or 20X is the answer to everything in life, because then you will do things like borrow money when you shouldn't, or maybe cut corners on things that your employer wants you to cut corners on. Ted Williams wrote a book called The Science of Hitting. And in The Science of Hitting, he's got a diagram, shows him at the plate, and he's got the strike zone divided into 77 squares, each the size of a baseball. And he says, if I only swing at pitches in my sweet zone, which he shows there, and he has what his batting average would be, which is 400. If he had to swing at low outside pitches, but still in the strike zone, his average would be 230. He said the most important thing in hitting is waiting for the right pitch. In investing, there's no called strikes. People can throw Microsoft at me and, you name it, any stock, General Motors, and I don't have to swing. And nobody's going to call me out on called strikes. I only get a strike called if I swing at a pitch and miss. So I can wait there and look at thousands of companies day after day And only when I see something I understand, and when I like the price at which it's selling, then if I swing, if I hit it, fine. If I miss it, it's a strike. But it's an enormously advantageous game. And it's a terrible mistake to think you have to have an opinion on everything. You only have to have an opinion on a few things. In fact, I've told students, if when they got out of school, they got a punch card with 20 punches on it, and that's all the investment decisions they got to make in their entire life, they would get very rich because they would think very hard about each one. And you don't need 20 right decisions to get very rich. 4 or 5 will probably do it over time. So I don't worry too much about the things I don't understand.
There's a whole bunch of things I don't know a thing about. I just stay away from those. Tom Watson said it best. He said, I'm no genius, but I'm smart in spots, and I stay around those spots. Well, I try and stay around those spots, and I just don't have a problem if somebody says, you're wrong on something. I go back and look at the facts. I think that really is much more important, frankly, than having a few points of IQ or having an extra course or two in school or anything of the sort. You need emotional stability.
The first rule in investment is don't lose. And the second rule in investment is don't forget the first rule, and that's all the rules there are. I mean, if you buy things for far below what they're worth and you buy a group of them, you basically don't lose money.
Biggest mistakes people make when investing?
Well, they try to... They just don't realize that all you have to do is just buy a cross-section of America and then never listen to people like me or read the papers or do anything subsequently. They think that because you can trade, you should trade. You buy a farm, you buy an apartment house, you can't resell it tomorrow. And the cost of moving around. Now you get something handed to you, liquidity, which is instant. You can sell, and the cost of doing it are pennies, compared to other kinds of investment activity. So because they can so easily move around, they do move around, and moving around is not smarter than investing. I can buy anything, basically. I've been on 400-foot yachts, and I've lived the life a little bit with people that have 10 homes and everything, and I live in the same house I bought in 1958. And if I could spend $100 million on a house and make me a lot happier, I'd do it. But for me, that's the happiest house in the world. And it's because it's got memories and people come back and all that sort of thing. So I am doing what I love to do with people I love. And it doesn't get any better than that, Judy. But I should be. I mean, why in the hell should I be working at 86 at something that I don't like or with people I don't like? The most important thing is really who you associate with. You want to associate with people that are better than you are. I mean, basically, you'll go in the direction of the people that you associate with. And you want to have the right heroes. You want people, if you want to emulate somebody, you better pick very carefully who you want to emulate. And when obviously you can't pick your parents, they're going to have an enormous influence on you, but you don't get a choice on that. But you get choices as you go down the line, and who you admire, who you want to copy, and the most important for most people in terms of that decision is their spouse. It's also important in terms of a partner in business, but the partner in life is the most important one. You want to pick a spouse that's better than you are, and then he or she, and you hope they don't figure it out too fast. Capitalism's all about somebody coming and trying to take the castle. Now, what you need is a castle that has some durable competitive advantage, some castle that has a moat around it.
So what's the secret?
The secret is to find what you love to do. I mean, I tell the students, look for the job that you would take if you didn't need a job. I mean, it's that simple. And I was lucky enough to find it very early in life. And then the second thing is to have people around you that make you feel good every day and make you a better person than you otherwise would be. I have more fun doing this than anything else I can think of in the world. And I've seen a lot of other things you could do in the world.
If you asked me to trade away a very significant percentage of my net worth, either for some extra years or being able to do during those years what I want to do, I'd do it in a second.